This situation with Japan and the unwinding of the carry trade is genuinely one of the most significant financial events in decades. The potential for $4 trillion or more to be wiped out of global markets is not hyperbole. It's a realistic assessment based on the scale of the carry trade and the speed at which it's unwinding. We're in uncharted territory here, and nobody knows exactly how this is going to play out. But what we do know is that volatility is going to remain elevated, markets are going to be choppy, and there are going to be both risks and opportunities for investors who stay calm and strategic. The coming weeks are going to be absolutely critical. We need to watch how the Bank of Japan responds to the market turmoil. We need to see whether other central banks step in to provide liquidity or support. We need to monitor credit markets for signs of stress and potential defaults. And we need to see whether this forced deleveraging stays orderly or spirals into a full-blown financial crisis. The next few days could very well determine the trajectory of global markets for the rest of this year and beyond. And that's why staying informed and prepared is so incredibly important right now. That said, the situation is serious enough that you should be taking a hard look at your portfolio and making sure you're appropriately positioned. If you're heavily concentrated in high-flying tech stocks or other risky assets, it might make sense to rebalance into more defensive positions. If you're close to retirement and can't afford to see your nest egg cut in half, you might want to increase your allocation to cash or short-term bonds. The key is to make rational, thoughtful decisions based on your individual circumstances rather than emotional reactions based on fear. For those of you who are younger and have a longer time horizon, this kind of market turmoil can actually present opportunities. When quality assets go on sale because of forced selling and panic, that's when fortunes are made. Warren Buffett has a famous quote about being fearful when others are greedy, and greedy when others are fearful, and there's a lot of wisdom in that. But you have to have the courage and the cash to act when blood is running in the streets, which is easier said than done. The credit markets are another area where we're going to see significant stress. Corporate debt has ballooned over the past decade thanks to ultra-low interest rates. Companies have taken on massive amounts of debt to finance everything from acquisitions to stock buybacks to dividend payments. A lot of this debt is going to need to be refinanced in the coming years, and if interest rates are significantly higher when that refinancing happens, some companies are going to find themselves in serious trouble. We could see a wave of corporate defaults, particularly among highly leveraged companies in sectors that are already struggling. The banking sector is also at risk here. Banks are essentially in the business of borrowing short and lending long, and when interest rates spike suddenly, that can create serious problems for their balance sheets. We saw this play out earlier with the collapse of Silicon Valley Bank and a few other regional banks when rates rose too quickly. Japanese banks in particular are going to be under enormous pressure, because they hold massive amounts of Japanese government bonds that are going to decline in value as rates rise. We could see bank failures both in Japan and potentially in other countries that have significant exposure to these dynamics. What about currencies more broadly? The dollar has been incredibly strong for the past couple of years, but this Japan situation could actually weaken the dollar if investors start pulling money out of US assets. On the other hand, if global risk appetite collapses and investors flee to safety, the dollar could strengthen even further as the traditional safe haven currency. Currency markets are notoriously difficult to predict, but we're definitely going to see significant volatility in foreign exchange markets over the coming weeks and months. The political implications of all this are also worth considering. Economic pain tends to translate into political upheaval. We could see governments fall, central bankers get replaced, and populist movements gain strength as people look for someone to blame for their financial losses. The Bank of Japan is already facing intense criticism domestically for this decision, and that pressure is only going to intensify if markets continue to crater. There's a real possibility that they could reverse course and cut rates again, but that would come with its own set of problems and would undermine their credibility even further. So what should you be doing right now? First and foremost, don't panic. Take a deep breath and assess your situation rationally. Look at your investment portfolio and make sure you understand what you own and why you own it. If you're not comfortable with the level of risk you're exposed to, make adjustments, but do so thoughtfully rather than in a panic. Consider talking to a financial advisor if you have one, or educating yourself further about investment strategies and risk management if you don't. Second, make sure you have an emergency fund. If we're heading into a period of economic turbulence, Having 3 to 6 months of living expenses set aside in cash can provide enormous peace of mind and financial flexibility. You do not want to be forced to sell investments at the worst possible time because you need cash to cover basic living expenses. Third, be very careful about taking on new debt right now. If interest rates are rising and credit is tightening, the last thing you want is to be over-leveraged. Pay down high-interest debt if you can, and avoid taking on new obligations unless absolutely necessary. This is not the time to be buying a bigger house or a fancier car on credit. Fourth, stay informed, but don't obsess. It's important to understand what's happening in the markets and the economy, but checking your portfolio every 5 minutes and watching financial news 24/7 is only going to stress you out and potentially lead to bad decisions. Set aside specific times to review your finances and stay informed, but don't let it consume your entire life. But here's where things get really interesting and really dangerous. When you have trillions of dollars built on a foundation of cheap Japanese yen, and that foundation suddenly shifts, everything built on top of it comes crashing down. And that's exactly what's happening right now. The moment the Bank of Japan announced this rate hike, the yen started surging in value. Now, normally, a stronger currency is seen as a good thing. But in this case, it's catastrophic for anyone who borrowed in yen and invested elsewhere. Think about it this way. If you borrowed 100 million yen when the exchange rate was 150 yen to the dollar, you essentially borrowed about $660,000. But if the yen suddenly strengthens to 130 yen to the dollar, that same 100 million yen debt is now worth $770,000. You just lost over $100,000 without doing anything, simply because of the currency movement. Now multiply that across trillions of dollars in carry trade positions, and you start to see the magnitude of what's unfolding. But the currency movement is only part of the story. The real devastation comes from what happens next. When the yen surges, investors who are in these carry trade positions face margin calls. Their brokers start demanding more collateral because their positions are now underwater. And when you get a margin call, you have two choices. You either put up more cash or you liquidate your positions. And guess what? When trillions of dollars in positions start getting liquidated simultaneously, markets absolutely crater. We're already seeing this play out in real time. Stock markets across Asia open sharply lower. European markets are getting hammered. US futures are pointing to a massive gap down at the open. And this is just the beginning. The real pain hasn't even started yet because these things take time to fully unwind. Right now, algorithms are still processing the information. Risk managers are still assessing their exposure. But over the next few days and weeks, we're going to see forced selling on a scale that we haven't witnessed since the global financial crisis. Now, you might be wondering why Japan did this. Why would they deliberately trigger such chaos? Well, the answer is actually pretty straightforward, even though the consequences are anything but. Japan has been dealing with inflation for the first time in decades. After years and years of deflation and stagnant economic growth, prices in Japan have actually started rising. The cost of food, energy, and other essential goods has been climbing, and the Japanese government finally decided they needed to do something about it. In normal circumstances, raising interest rates to combat inflation is textbook monetary policy. It's what central banks are supposed to do. But Japan isn't operating in normal circumstances. They've painted themselves into a corner over the last 30 years with their ultra-loose monetary policy. They've created a situation where the entire global financial system has become dependent on cheap Japanese yen, and now they're trying to normalize policy without causing a complete meltdown. The problem is, I'm not sure that's even possible at this point. The ripple effects of this decision are going to be felt everywhere. Let's start with the obvious one, the stock market. Equity markets around the world have been propped up by cheap money for years. Low interest rates made borrowing easy, which meant companies could finance expansion, buy back shares, and pay dividends without worrying too much about the cost of capital. Investors could borrow cheap yen, convert it to dollars, and pour it into US tech stocks or whatever else was hot at the moment. But now that source of cheap funding is evaporating, and that means less money flowing into equities, which means lower stock prices. But it goes way beyond just stocks. The bond market is going to feel this too. When interest rates rise in Japan, it makes Japanese government bonds more attractive relative to other sovereign debt. That means investors might start pulling money out of US treasuries, German bunds, and other government bonds to chase higher yields in Japan. And when bond prices fall, yields rise, which means borrowing costs go up for everyone. Governments will have to pay more to finance their debt. Corporations will face higher interest expenses. Consumers will see their mortgage rates and credit card rates climb. It's a cascade effect that touches literally every corner of the economy. Real estate is another sector that's going to get absolutely crushed by this. Property markets around the world have been inflated by cheap money and easy credit. When interest rates were at zero, taking out a massive mortgage seemed like a no-brainer. But as rates rise and credit tightens, demand for real estate is going to plummet. We're already seeing cracks in the Chinese property market, and this Japan situation is only going to make things worse. Commercial real estate, which is already struggling with the work-from-home trend, is going to face even more pressure as financing becomes more expensive and harder to obtain. Emerging markets are particularly vulnerable in this scenario. Countries like Turkey, Argentina, South Africa, and many others rely heavily on foreign capital inflows to finance their current account deficits and support their currencies. A lot of that capital has come from the carry trade, with investors borrowing cheap yen and investing in higher-yielding emerging market assets. But as the carry trade unwinds, that capital is flowing back out of emerging markets at a rapid pace. We're already seeing emerging market currencies getting hammered, and their stock markets are in free fall. For countries that have significant dollar-denominated debt, this creates a double whammy because their currencies are weakening at the same time that capital is fleeing, making it even harder to service their debt obligations. The cryptocurrency market isn't immune either. Bitcoin and other digital assets have benefited enormously from the flood of cheap money sloshing around the global financial system. When you can borrow yen for nothing and there's a speculative mania happening in crypto, it's natural that a lot of that borrowed money found its way into digital assets. But now, as leverage gets unwound and risk appetite disappears, we're seeing crypto prices tumble. Bitcoin has already dropped significantly, and altcoins are getting absolutely destroyed. The crypto market is particularly vulnerable because it's still relatively small and illiquid compared to traditional financial markets, which means price movements can be extremely violent in both directions. Now, let's talk about what this means for regular people, for folks who aren't hedge fund managers or institutional investors. If you have a retirement account, a 401k, or any kind of investment portfolio, you're probably watching your account balance shrink right now. The knee-jerk reaction for a lot of people is to panic and sell everything to get out before things get worse. But here's the thing, and I cannot stress this enough, panic selling is almost always the wrong move. History has shown us time and time again that the investors who do the best over the long term are the ones who stay calm during periods of volatility and stick to their plan. $4 trillion on the line. Markets are bleeding, and it all started with one unexpected decision from Japan. Right now, as you're watching this, financial shockwaves are rippling across global markets. The Bank of Japan just made a move that nobody saw coming, and Wall Street is in absolute panic mode. We're talking about potential losses that could dwarf the 2008 financial crisis. Here's what's happening. Japan has held interest rates near zero for decades. They've been the world's piggy bank, funding everything from US Treasury bonds to tech stocks. But in a stunning reversal, they just pulled the rug out from under the entire global financial system. The yen is surging. The carry trade, worth trillions, is unwinding at lightning speed. Hedge funds are scrambling. Algorithms are going haywire, and retail investors, they're about to get caught in the crossfire. This isn't fear-mongering. This is happening right now. Major indices are already down, and we haven't even seen the full impact yet. If you have money in the market, a 401k, or even a savings account, you need to understand what's unfolding. In the next few minutes, I'm going to break down exactly what Japan did, why it matters to your money, and the 3 moves you need to consider making today before this gets worse. If you want to protect your portfolio and stay ahead of this crisis, smash that like button right now and let's dive in. Alright, so let us talk about what is actually happening here, because this situation is absolutely wild and the implications are staggering. I've been watching financial markets for years, and I can tell you with complete certainty that what we're witnessing right now is not your typical market correction. This is something fundamentally different. Something that has the potential to reshape the entire global financial landscape as we know it. Now, before we go any further, I need you to understand something critical. The Bank of Japan has been the cornerstone of global monetary policy for the better part of 3 decades. When I say cornerstone, I'm not exaggerating. We're talking about an institution that has essentially bankrolled a significant portion of global economic growth through what's called the carry trade. If you're not familiar with that term, don't worry. I'm going to explain everything in detail, but just know that this carry trade has been worth trillions upon trillions of dollars. And it's been one of the most profitable strategies in modern financial history. So what exactly did Japan do? Well, after maintaining interest rates at essentially 0% or even negative rates for nearly 30 years, the Bank of Japan shocked the world by raising rates significantly higher than anyone anticipated. Now, you might be thinking, okay, they raised rates, so what? Countries raise interest rates all the time, right? And you'd be correct, but here's the thing. Japan isn't just any country. Japan is the third largest economy in the world. And more importantly, the Japanese yen has been the funding currency for an absolutely massive portion of global investment strategies. Let me paint you a picture of how this worked. Imagine you're a hedge fund manager or an institutional investor. You could borrow money in Japan for practically nothing. We're talking interest rates near zero or sometimes even negative, which means you were essentially getting paid to borrow money. Then you would take that cheap Japanese yen, convert it into dollars or euros or any other currency, and invest it in higher yielding assets around the world. Maybe you'd buy US Treasury bonds yielding 3 or 4%. Maybe you'd invest in European corporate bonds. Maybe you'd pour it into emerging market debt or equities. The possibilities were endless, and the profit potential was enormous. This strategy worked beautifully for decades because the Bank of Japan kept rates at zero and showed absolutely no indication that they would ever change course. Investors got comfortable, they got complacent, they leveraged these positions to the moon and back, borrowing more and more Japanese yen to fund bigger and bigger bets across global markets. And why wouldn't they? It was essentially free money. The risk seemed minimal because Japan had demonstrated time and time again that they were committed to keeping rates at zero forever.